I have a 375 unit apartment complex that I'm buying. And if you want to invest with me, we have the option for you to do that. Well, I just took a bunch of investors through the entire deal, and I want to show you this deal so you can see. If you want to invest, you absolutely can. Check the link in the description where you can give me your information and I'll reach out to you and see if you're a good fit to invest with. But at the same time, I want you to learn what it looks like and what it takes to invest in a multifamily, something as big as a 375 unit apartment complex. We're raising $9.2 million. The purchase price is $25 million. But in the end, I want you to realize that we play Monopoly here at Master Passive Income. As real estate investors, we play in Monopoly because eventually we get from single family homes into large apartment complexes. But then we also have ability for other people to invest in our deals. So let's walk through this entire deal deck so that you can invest in real estate with me if you would like, but then also learn how to do multifamily investing. This is Jason Urisi. Known it for a good 5 years now, speaks at my conference, fantastic multifamily investor. And so what we're going to do is we're going to walk through the other partners like Jason. They're not on the call, so Jason's definitely going to help fill in lots of gaps here. So this is Jason and Pili Rusi, good friends of mine. They actually live like 5 minutes away from me. So we moved here in Murfreesboro, Tennessee. But Barry, didn't you go to Middle Tennessee?
I went there for sales school 101.
Oh, get out of here. How cool.
Awesome, awesome. Okay, so yeah, 3,000 units acquired, over $280 million in multifamily since 2016. Started and exited multiple businesses, construction background, family man. Great. We just had him over for dinner this last was it Sunday night. So yeah, fantastic family and super fun. His wife also is a part of the business as well. She does a great job on top of that. Then we have Chad and Jen King. So a little funny, quick story. Chad was playing golf with I think it was the not mortgage,
The broker.
the broker. Yeah, the broker, the deal. And so they were playing golf. And at the time, while they're playing golf, this deal came up. And fast forward now, it was because of playing golf, which I know Joe Smith is a big golfer. So he would definitely appreciate it. There we go.
Here.
But 25 commercial multifamily properties, that, lots and lots of units. 12 properties taken full cycle. You know what? I don't need to go through all this stuff. You guys can look through this. I don't want to take up too much time, but Chad and he's done a great job with the other property. So all three of these other partners with myself are on the Cove, which is another deal that we closed in May, right in Murfreesboro near Nashville. This one is in Chattanooga, and we have Bill Allen, super awesome guy too, and he has lots of experience in multifamily as flipping and real estate and all that sort of stuff. Retired Navy pilot as well, but he lives in this area as well, probably about a good, 45 minutes away from me, but we're all literally in this area. And this new property is looking fantastic. Obviously, hopefully most of you guys know me, obviously, but I love investing in real estate. I love helping people how to invest in real estate, but then also super blessed to have 5 kids. We have our brand new one. She's 8 months old now, and she's just a blessing. But yeah, looking forward to this next property. Then we got, I'm going to have Jason take it over from here, from the executive summary. He's going to be able to walk you through. So Jason, you want to take it away?
Yeah, so good to meet everyone. My name is Jason Urisi. Dustin, good to jump on with you tonight. So Dustin and I first met, as he said, about 5 years ago now, and this was the first opportunity to work together a little over a year ago. However, Chad King and his wife, and Bill Allen and myself and my wife, we've actually been working together on multifamily properties back beginning in 2019. So we brought and sold about 500 units up in Louisville before working on a bunch of different properties in a couple different markets, all the way from properties in North Carolina, South Carolina, Ohio, Georgia, and of course, Tennessee. So we've done a number of deals together. The majority of it has been all large multifamily apartment complexes. The town that Dustin and I live in, we own just shy of 1,000 units together of a number of large apartment buildings here. This property is in Chattanooga that we're here to discuss today. Like Dustin said, Chad is the lead on finding opportunities. So he was out golfing with one of the brokers, Kirkland and Company. It's a broker we've worked with 6 times here in Tennessee, and it was actually 3 times up in Louisville. So we've worked with them in a number of different times, and they were there walking this property, and Chad was able to basically tag along, was able to meet the owner, and that started the relationship. So this was done truly off market, although there was a broker involved. That broker fee will be paid by the seller, but this communication honestly started with Chad meeting direct to seller, which was a very good way for us to get in front of it. It comprises of 2 different buildings, and the cool thing about this is that the son and the sister, so the son and daughter of the parents actually own this, but the parents built this back in 1976 or 1977 and 1986, and so it's comprised of 2 different buildings: Rustic Village, which is 223 units, and Rustic Village North, which is about 10 minutes away, which is 152 units, and this total is 375 units. It's a real true mom and pop operation where it's basically been passed from the parents down to the kids, and the kids now run it, and they run it just like they have from the hip. So they don't have a true management team and process. They don't really have true operations and process. They just do as they feel, and they've treated this really as almost their piggy bank. And it's really located in a great position. It's 10 miles from Chattanooga office, less than 6 miles apart. It's the 2 properties with immediate economies of scale. Easy access to major employment hubs, including Volkswagen, Amazon, and Blue Cross and Blue Shield. And we've done and dealt with a number of different properties in very similar locations. So we're using the same management company that manages our properties here in Murfreesboro, Tennessee. We're about an hour away to where this property sits in Chattanooga. The property management company that we use manages just shy of about 4,500 units, predominantly in the county. So they have a very good footprint. They've been around since 1970. Really strong relationship both on the front end of just lease up all the way to the renovation plan. So we'll use a strategic capital improvement plan focusing on modernizing the unit interiors, enhancing curb appeal, and upgrading community amenities. Really good push for this thing is there is very little on-site presence that puts us in a good light. So this is going to be complete rebranding. There's no websites. They don't really have a good footprint on social. So we'll go and rebrand these properties to new names, give it a new face appeal, and really start changing the story very quickly on this. Dustin, want to jump to that next slide? So here's some of the deal highlights. We'll talk to why the price per unit is a very attractive price a little bit later into this, but $68,000 per unit on the purchase, and we're basically purchasing this below replacement cost with opportunities just to enhance the NOI just straight out of the gate, both from the revenue side to the expense side. We source this off market. We've used underwriting that we feel is very conservative to the nature, and we'll talk to this based on the comps later, compared to what we feel we will be able to produce with the operations we'll put in place. The management team, I talked to this a little bit earlier, but they have considerable experience to improve operations, and Chattanooga is projected for 44.5% job growth over the next decade. So a ton of activity going down here. It's a very central point. It's actually split right between Nashville and Atlanta, so it's a very easy access hub from both cities. So there's a lot happening in Chattanooga. We'll talk a little bit about a lot of the drivers that are coming on later. And the portfolio's location size provides strong economies of scale with both properties 6 miles from each other, 10 miles from Chad's actual Chattanooga office. I'm going to talk a little bit here, this part of the investment highlights. This is a 506C opportunity. And so that means that this allows just for accredited investors. The whole period is 5 years, and investor partners will participate in a quarterly distribution with a preferred return of 8% and a 70-30 split between partners, with 70% going to you as a limited partner, and then we would partake in a promote of 30%. The preferred return being 8% membership ownership, meaning that each year, on average, if you invested $100,000, our preferred return would mean that we would have to return $8,000 per year to you before we would partake on any of the upside in the deal. If we did not hit that mark, say we hit 6,000, then in the following year, we would have to meet that 8,000 plus the accrued 2,000 from the year prior. Our investor yield projections are an equity multiple of 2x, an average annual return of 20%, internal rate of return of 16.48% and an average cash and cash of 6%. We're going to purchase this property for $25.5 million. We're looking to put in just over $4 million of capital improvement with closing costs and operating capital at closing of $973,000 for a total capitalization at closing of $31,325,000. Our total raise amount for this project is $9.2 million. And again, we're purchasing the two properties together that are 375 units that were built in two different tranches between 1977 and 1986. Currently, the property is occupied at 95%, so he is occupying it. However, on that front, we're putting on debt that meets an interest rate of 6.89%, a term of 5 years with proceeds of $22.1 million of the loan, which is a loan to cost at closing of 71%. We will have 2 years of interest only, meaning that the property will not start amortizing until year 3. And that gives us time to go in there, make the renovations, make the improvements as we choose to go in there and get the best from the property before we start amortizing through the loan. Here's our year 1 performance. So you will see between year 1 and year 2, we have substantial increase in income. That said, we are going to have a very aggressive lease-up plan on the property. Currently, the rents average $475 and $495 a unit on average between the 1 and 2 bedrooms and across both properties. Average rents, as you'll see later, are anywhere between $900 to $1,300 on comparable properties right in the area. So our goal right at the bat is that we're going to go and push up leasing, and we will carry some heavy vacancy in year 1 as we really turn over the bad actors or the tenants that we don't own on the property and start to change the narrative of the property to bring on new properties. We have a number of things that you'll see across this that will drive year 1, where we'll do a lot of the renovations with a goal to be done with full renovation package 16 months into the property. This talks to our expenses. If you look at the T12, the property management fee, a lot of this is going to the seller and his family. So we'll bring this into tolerance, which is the top line item there, into 4%, which will be paid to the current property manager. The general administration, same thing, is $904,000. A lot of this is just being paid out to family. He's using this basically as a piggy bank to pay out his family. So we will bring a lot of these numbers back into tolerance. Same thing here. Payroll will stay in line. He has the staff and where they see on their payroll. That should be in line. But the repairs and maintenance they've done on the Rustic Village property, which is the south property, they've done a lot of band-aids over the years, and so they've spent a lot of money just putting in the minimum to keep it going. So it's been very expensive to operate this year in and year out. We will do the one-time fixes correctly with our CapEx or construction budget to put this in line, and that's why you see the number of repairs and maintenance come down into tolerance. Real estate taxes, out of the gate, we've already had our tax advisor assess this, so we will have increases going in year 2, but out of the gate, we should find our properties be able to be reevaluated to find our taxes down to $341,000 based on the analysis here. And that jumps to see that you'll see our net operating income from where you stand in year 1 to year 2 with a nice jump continually increasing throughout the hold all the way through year 5.
Sorry, I was going to say, I don't know if you heard, but Tennessee, and hopefully it goes through, but it's on the ballot, or hopefully going to be on the ballot. It looks like it's going through to get rid of property taxes, which in general I'm super stoked living here in Tennessee now, but that would also be a huge bump in total income that we have.
Tennessee is a very interesting state. So I moved here from New Jersey, right? So I've had both spectrums of how states operate, and there's a lot of pro-business and just pro-people things going here. So this property really speaks to that narrative. It's also a landlord-friendly, right, business-friendly property or state. So it also helps us if we have to use any eviction measures from there. So if we look here across the property, 223 units, Rustic Village and Rustic Village North. Rustic Village makes up 59% of the units, while Rustic Village North is 41% of the units. The rent per square feet, and we'll talk to why this is important later, is 91 cents per square foot, while Rustic Village North is $1.14 per square foot. So the in-place rents, $599 and $573. And we're putting this as a stabilized rent per unit at $923 per unit and $926 per unit. We'll show you a little bit later on the rent comps why we feel this is very considerable. Our exit cap based on sale is a 6% cap, which is really, in terms of the market right now, even with the elevated interest rates, you're seeing a lot of transactions still fall in line with that and lower. So we feel very good with that. With our purchase price of 25.5 and our exit price being right at 39 million, which is $104,000 per unit. We'll get to the comps later to why we feel that's still very in line, even not in taking into account that this will be 5 years out from where we stand. The amortization for the loan is 30 years. We talked a little bit earlier, the rate is under 7%. So here in the model, it's actually 6.89%. If you've been tracking the markets, the 5-year treasury has actually dipped dramatically. So we are actually down 40 points right now. If we were to lock this rate today, this rate would be about 6.42 today, where we would actually close this loan out. That's of course not in the underwriting, right? Because this is a fluid metric. But in that point, the rate, if we were to lock today, would be substantially lower than what we sit today. This is our annual debt service coverage base, or our debt service based on this 6.89%, 1.5 million with a debt service coverage ratio of 1.35 and debt yield of 9.9%. Financial analysis. This just shows the cash flow based on the investment, right? So if you were to invest $100,000, year one, it'd be about $4,000 cash flow. Again, we're putting in a lot of the construction work. Year two, just shy of 8,000 for the investment. Year five and year three, year four, and year five, we drop down to 5, basically 6 and 6,000 a unit. Why that happens? We start amortizing. Right, so the loan will start amortizing, so some of your return will go to be paying down a loan at that time, and that's why the cash flow will be affected at that moment. But you will see in year 5 you have the capital event here, 171,000, which leads to your total return of 30,222 plus 171,646 together, just over $200,000 return, which does include the initial capital being returned to you as well in terms of that capital event. So here's the property management company, MMC, founded in 1988, locally based in Murfreesboro, Tennessee, manages just shy. This is actually, even my slide, a little bit outdated on this point. So they're over 4,000 units. They manage a lot here in Rutherford County. They do a tremendous job. Jean, she started the company. She's got a fantastic team around us. I have property management companies in a number of states, and if most are a 7 or 8, they're a 12 out of 10. So they are top notch. They do the best job. They're very dialed in. They don't invest, or they don't manage out of state. So they really have their finger on the pulse, know exactly what's happening, are able to just adapt in a great way to keep these properties operating in the best fashion. And we have, between all of our units we have with them, we are anywhere between 94 to 97% occupied, with lease rates at market or above across all of the properties we have. This is just an aerial view, so you can see the properties themselves, where they sit. It also has a ton of acreage behind them where a lot of the amenities send. So a lot of the CapEx that will go to the exterior of the buildings will also be for a very big revamp of the amenities. That was Russell's Village North. As you can see here, within 10 miles of this, we have 369,000 people. So very, very attractive amount of people here in a density area. We call it the MSA, but for the MSA being the city in itself, for us to invest, we look at having at least 250,000 people, and that's typically in the MSA, right? The Metropolitan Statistical Area. This within 10 miles is 369,000 people. So it's a ton of people that would be able to serve this area, serve this property. The population growth looking over the next 5 years is just 6.5%. A ton of household formations, a ton of growth. Average household income is 85,000 going within a 10-mile radius, which also serves this picture very well. Typically, we like to see anywhere between 50 and 90. So this is a really nice sweet point for us. Median home values, again, 182 all the way to 245,000. So a really good picture for how this property can be served by the surrounding community. This is the other property, Rustic Village itself. Same thing as you see, very big footprint across the property, and again has a very nice amenity structure that's right here next to the clubhouse, right in the middle. So again, really good, strategically located right by the highway, very good access points. And again, as we see here, just like the other property, 356,000 people, 6.25% population growth, household income, again, right in that sweet spot, 72,000, 69,000, 81,000 from 3 to 10 miles. So really puts us in a good position to have the right type of tenant base to serve the property. So here's some more of what you see here, all the things going on, right? If you look here where the two properties sit, you have Chattanooga Airport right in the middle, University of Tennessee, Chattanooga right in that part. On the south side, you have Chattanooga Choo-Choo, Finley Stadium, galleries on William Street. Up to the north, right, you have North Shore, Renaissance Park, Coolidge Park, Chattanooga Theater. In the riverfront, you have AT&T Field, the museum, the aquarium, River Market, a ton of things. And so this is really strategically set right here in the heart of Chattanooga. Here are some of the employment drivers, right? As you see, Urinin, TVA, Cigna, University of Chattanooga, a lot of things, Coca-Cola, Vulcan, Amazon, Volkswagen, right? So this serves to who our tenant base is. Working through Coca-Cola, working at Volkswagen Center, working at Amazon, working at Cigna. This serves to who will be the employers for the tenant base on the properties. This just talks a little bit more about the area views, what's in line here. So golf course, the town centers, the interstates, the highways. And for us, I mean, this is a straight shot to get to these properties. We live off a highway 24. 24 takes us straight to Nashville, and Nashville will take us straight up once it hits 65 to Louisville, and you take this south directly down through Chattanooga, and then this continues on before you hit 75 to take you to Atlanta. So this highway is very is just a nice vein. Thousands of cars traffic this highway each day that bring you in line to take you from each of these cities. Rent comparable. So this is where it's going to really serve if you jump into the next slide here. These are the prices we're talking, and if you look here at this between the two properties, 375 units, our studio rent's $493, one bedroom $583, and two bedrooms $667, which gets us into that blended about $495 a unit. You look at the comps, and a lot of these comps, that talk good, right? If you look across here, 590, just for instance, if you look at the one bedrooms, $583 of every comp on this list. Some properties have some renovations, some have no renovations. They're all renting, except for the last one, which is at $999 plus $1,000. Look at the two bedrooms, it's even more of a delta, $667 for the two bedrooms. Look at all the comps. This is because the ownership group, their goal was always to keep it occupied, right? So for them to go in there and talk about spending $5,000 or $6,000 to get a $400 or $500 rent bump, that's not appealing for an ownership group that's owned it for a long time, because they don't see or feel that return for a number of years. So for us, that strategically drives up our bottom line, which helps us to improve, of course, our sales cost and overall value of the property. And so our big intention will go and really modernize the units to a fact. And it doesn't take much. I mean, the units just really haven't been managed well, haven't been marketed well. So this is not a whole gut renovation in there. They have beautiful layouts inside. They're very big, they're very spacious units. So we'll get in there, do a very moderate renovation package, actually similar to the property that Dustin and I just brought last year in the Cove. And so these are not high-end upgrades. These are very basic workforce upgrades that are going to be able to get us a very substantial increase in the rent just by doing that dialed-in approach and putting in the right team and the right marketing plan. Sales comparables, this will help a little bit too. Talked to earlier. Go to that next page right there. So as you see here, a lot of these transactions were in 24, except the one down there. The price per unit, we're buying this at a $68,000 a door. All of these have traded over 105 a unit. It really puts us in a good spot, because we're modeling out to sell at 104 a unit. But the comps today on today's numbers, not taking into account future inflation or future improvements, they're actually selling above the basis of numbers that we are considering for sale into the future. This is the standard investment disclaimer. This just talks about that we are selling security here, right? So this investment comes with the inherent risk that could be at any investment. So please read this in detail. It will go through any parts just to make sure you understand. And with this, if you've not invested into a syndication before, this will be investing through a private placement agreement. So you will have that document. You will sign a subscription agreement. and that will basically signify your investment before funding. So make sure you look into this, and we would be happy to talk through between Dustin and myself, whether it be on a call separately from this or through email, any questions you have on any of the investment documents.
And that is our deal in Chattanooga, 375 units. We're getting it almost 50% of the market value, which is absolutely amazing. And if you want to invest with me, check the link in the description, fill out the form. It's literally just give me your information so I can reach out to you and see if you would be a good fit for investing with me in my new apartment complex. And then as we get more deals, we'll still have your information for the next deals if it doesn't work out for this one. But I want to see you to invest in real estate. And if you want to invest with me, you absolutely can. But in the end, I want to see you become a successful real estate investor. So hopefully this education has helped you. And I'd love to see you invest with me, but I'll see you guys in the next one.